Hello, Bitcoiners. Thank you very much. Hello.
Picture a colossal tower collapsing spectacularly. A digital coin that's not quite real, but somehow worth more with each day. A famous investor parting ways with his favorite fruit stock. And a political landscape with more twists than the entire Real Housewives franchise. Welcome to Do Academy. Be sure to like, share, and subscribe for more videos like this. In this video, we'll recap the most explosive stories that made 2024 the year it was. In January, Evergrande, the property giant that once built cities on the hopes and dreams of homeowners, was officially ordered to liquidate by a Hong Kong court after 19 months of failed negotiations with overseas creditors. Yep, after months of saying, "Don't worry, we've got this," spoiler alert, they did not have it. The court finally stepped in and said, enough is enough. The announcement tanked Evergrande's shares by over 20%, and then trading was suspended faster than someone yelling, check please, on a bad date. It was the court's way of closing the lid on a dumpster fire, hoping to contain the damage before it gets any worse. But here's the issue. It's not just Evergrande's mess. This whole debacle has left China's property sector looking as stable as a Jenga tower in an earthquake. And because Evergrande owes money to literally everyone, from international banks to investors to suppliers, global markets are nervously thinking, how bad will this get? Looking ahead to 2025, things aren't exactly rosy. Property values are dropping, investors are panicking, and the Chinese government is under pressure to clean this up. So far, they're in full "we'll fix this" mode. But remember, that's what Evergrande said, and look how that turned out. Fueled by the SEC's approval of spot Bitcoin ETF in January, Bitcoin transformed from a nerdy teenager to the prom king. Starting with a bang in March, Bitcoin shattered its all-time high, hitting over 73,000 USD before retreating in the summer months, trading mostly in the 60,000 USD range and falling below 55,000 USD in September. Fast forward to November, Bitcoin was on fire, hitting 77,000 USD right after the 2024 US presidential election, then racing to 80,000 USD before blasting past 90,000 USD. By November 21st, fueled by optimism over Donald Trump's pro-crypto stance, Bitcoin had reached a jaw-dropping 98,000 USD. That's right, once playfully called magic internet money, Bitcoin is now worth more than actual magic. Naturally, everyone had something to say. While the SEC may approve Bitcoin investment products, it's still playing the cautious parent, warning investors to watch out for the risk. Then there's Donald Trump, whose pro-crypto stance and presidential win sent Bitcoin soaring. At this point, Bitcoin's price chart might as well run on drama. But then Bitcoin did what it does best, being unpredictable, because the price stopped rallying on November 25th and crashed near to 90,000 USD on the 27th. But Bitcoin wizards were back smiling on December 5th when the price finally hit the 100,000 USD mark, as predicted by analysts. Currently, predictions for Bitcoin's price in 2025 range between 150,000 to 300,000 USD, reflecting both bullish and cautious outlooks among experts and analysts. But as always, Bitcoin's fate also depends on wildcards like regulation, the global economy, and love tweets from Trump or Elon Musk. Whatever the future holds, 2024 proved one thing for sure. Bitcoin didn't just make headlines, it is the headline. From July to October, Warren Buffett, the man who embodies long-term investing, shocked the world by doing something wildly out of character. He sold a lot of Apple stock, like 600 million shares a lot. That's 25% of Berkshire Hathaway's Apple holdings, worth a casual $175 billion. You know, just your average Tuesday for Warren. So, why did the Oracle of Omaha decide to offload a chunk of his beloved Apple stock? According to reports, it's high capital gain taxes and market valuations. But don't worry, Apple is still Berkshire's top holding, valued at a whopping 69.9 billion USD.
Doing it at 21% this year, and we're doing it at a higher percentage later on. I don't think you'll actually mind the fact that we sold a little Apple this year.
This move, of course, sent investors into a mild panic, as this was seen as a signal of shifting sentiment from one of the market's most cautious investors. Meanwhile, Berkshire's cash reserves ballooned to a record $325 billion USD by November. That's enough cash to buy actual islands. But for Buffett, it's all about patience. He's sitting on that pile and waiting for the market to scream, "Everything's on sale!" Heading into 2025, Buffett's strategy is clear. Hold cash, stay cautious, and wait for the perfect opportunity. Analysts expect him to swoop into undervalued sectors or defensive plays like some kind of investing Batman. Until then, he'll keep doing what he does best, reminding us all that sometimes the smartest move is to do absolutely nothing. Well, unless you're selling 175 billion USD in Apple stock.
We did it!
On July 5th, Keir Starmer pulls off a political mic drop, leading the Labour Party to a landslide victory and ending 14 years of Conservative rule by beating ex-Prime Minister Rishi Sunak. It was Labour's biggest win since Tony Blair, and Starmer's agenda promises a lot of big changes, including a pro-European stance, green investment, and fingers crossed, a less chaotic UK government. The markets quickly got behind Starmer's win. The FTSE 50 jumped 1.8% in the first week, and the pound sterling gained 2% against the dollar. Green energy and infrastructure stocks also soared, thanks to Starmer's promise pour money into renewables. But not everyone was thrilled. Utility companies felt the heat as whispers of renationalization started making rounds. Starmer's victory signals a massive shift in UK fiscal policy, with a focus on economic growth, public service reform, and fixing what he calls UK's productivity gap. Looking ahead to 2025, the big question is, can Starmer deliver? His green energy push could attract major investments, and a cozier relationship with the EU might ease trade tensions. But balancing increased fiscal spending with inflation control? That's a bit like trying to fix a leaky boat while rowing it upstream. And let's not forget, markets love growth policies until they have to start paying for them. Also in July, the Bank of Japan, a central bank so famously cautious it makes a turtle look reckless, finally took a slow and steady step to combat rising inflation. After years of keeping interest rates at 0 to 0.1%, they finally bumped it to a whopping 0.25%. This tiny hike was like spinach to Popeye because within a week, the yen strengthened by 7% against the US dollar. Great news for households hit hard by rising import costs and inflation. But, and this is a big but, this seemingly innocent and small ripple sent shockwaves through global markets. Investors who were playing a risky game of borrowing cheap money in Japan and investing it elsewhere were scrambling to cover their positions. This mass selling led to a sharp decline in stock markets worldwide. The Nikkei 225 index plummeted 12% in a single day, its biggest one-day drop since Black Monday in 1987. Topix, or Tokyo Stock Index, took a 20% nosedive, faster than you can say landslide. The S&P 500 and the Nasdaq Composite were also caught in the waves, plummeting by around 3% and 3.7% respectively in early trading. Futures on these indices fell by 4 to 5% before the market even opened. And while the initial talk of Japan's interest rate hike has subsided, looking ahead to 2025, consumer spending and investment may cool off due to rising borrowing costs, potentially impacting corporate earnings and stock prices. Inflation, as we know, remains like a toddler. Unpredictable, messy, and always breaking something. The BOJ is, as always, walking a tightrope, stabilizing the economy without accidentally flipping the recession switch. In September, the US Federal Reserve made a move so rare, it might as well have been a Bigfoot sighting. The interest rate was cut for the first time in 4 years, dropping from 5.5 to 5%. Naturally, the rate cut sent ripples through financial markets. The US dollar fell to a 14-month low with a 1.2% decline against a basket of major currencies that week. Exporters cheered, while American holiday goers cried into their overpriced Parisian croissants. Stocks reached record highs a day after the announcement and saw the S&P 500 rose by 1.7% and DJIA by 1.3%. Gold also hit record highs, as investors started hoarding it like prospectors during the 1849 gold rush, up to a 5.4% increase that entire month. And yes, even magical internet coins rallied as Bitcoin jumped 5% the day after the announcement. Then when November came, the Fed yelled surprise and slashed the rate again to 4.75%. This back-to-back move made one thing clear. The Fed is determined to jolt the economy awake. Looking ahead to 2025, these cuts could keep fueling spending and investing, but don't get too comfortable. This plan only works if inflation stays quiet and the global economy doesn't throw a tantrum. And let's not forget, how low can rates go before banks start sweating like someone wearing a sweater in June? October saw a move that shocked the tech world when Russia slapped Google with a fine so absurd it made monopoly money look like real currency. 20 decillion rubles. Yep, you heard that right. 20 decillion, which is 20 billion trillion US dollars. Put that in perspective, that's more than the entire global GDP combined. So what led to this financial megastorm? Well, Google had the audacity to remove Russian state-sponsored channels from YouTube. Apparently, Putin wasn't a fan of that, so he retaliated with a fine that makes King Midas look like a budget shopper. But let's be real, we know Google isn't gonna pay this fine. How could they even? It's more of a political spectacle, like a peacock fluffing its feathers, attention-grabbing but lacking any real consequence. In terms of impact on Google's bottom line, practically nothing. In fact, Alphabet's shares rose by 5% right after the announcement. Looking ahead to 2025, we can expect more regulatory showdowns like this. As big tech continues to face pressure from governments all over the world, particularly in politically volatile regions like Russia, companies like Google may start recalibrating their operations. But don't worry about Alphabet's future, it's still well positioned for growth. Unless, of course, Russia comes up with a new 50 decillion fine. Then we might be in trouble. In November, it was finally made official. Intel was kicked out of DJIA, and in its place, like a glowing beacon of technological promise, comes Nvdia. So what happened? Intel, a company once synonymous with processors, suffered a massive 15.64 billion US quarterly loss. Meanwhile, Nvdia was off flexing its 168% increase in net income, proving that if you want to be on top of the tech world these days, just focus on AI and GPUs. Looking ahead to 2025, Nvdia is expected to continue riding high on AI and GPU demand, cementing its place as an investor favorite. Meanwhile, Intel will likely focus on restructuring, which is corporate code for please love us again. Investors will definitely be watching both companies closely, hoping for a comeback or another disaster. After months of political theater, November saw a knockdown in the 2024 US presidential election when Donald Trump defeated Kamala Harris to be the 47th American president. Despite the Democrats' anti-Trump rhetoric, the world didn't go to hell. The US dollar immediately shot up by 1 to 2% against major currencies like the yen and euro. Meanwhile, the stock market had one of its best post-election performances in history. The S&P 500 rose by 2.5%, the Nasdaq by 2.7%, and just for fun, even shares of Trump media went up by 15%, proving that miracles can happen. Bitcoin soared past 75,000 USD, while gold hit in the corner, losing 0.8%. Who knew that digital coins would be more popular than the shiny rock we've been hoarding for centuries? Oil tanked as well, thanks to Trump's promise to drill baby drill to lower fuel costs for Americans. Looking ahead to 2025, Trump's victory is expected to fuel stock market growth because nothing says stable economy like chaotic tweets and corporate tax cuts. The US dollar could stay as strong as his self-confidence, and Bitcoin probably off doing whatever Bitcoin does best, climbing, falling, then climbing again, like a drunk trying to find their Uber. And Trump's oil obsession? Let's just say the energy market's in for a shakeup. But let's not forget, policy shifts and trade tensions could still send investors into an endless stress spiral. Fun times. And there you have it, 2024 in all its unpredictable glory. From stock market surges to international shakeups, we've seen that the world of finance never stays still for long. Which was your favorite story? Share your thoughts in the comment section below. As we look toward 2025, the question remains, what's next? Will AI continue to drive tech stocks to new heights? Will global tensions influence the markets in ways we can't predict? Whatever happens, you can be sure that the ride isn't over yet, because a new year of financial saga is just around the corner. For more financial and investment insights, visit the Do Academy website today.